Well, hello learners, Leon here, and today I want to dive further into a Canadian stock that I recently put some money in that pays a 15% dividend. Now, usually if we see a stock that pays such a high dividend, we're pretty skeptical of its earnings. In fact, this company not only has negative earnings per share for the most recent quarter, it also has a 140 debt to equity ratio. But in this video, I'm going to uncover the truth behind what's actually happening at the company and why I still bought it. We're going to look at the company's financial statements, why net income for this business is one of the most misleading figures. And I mean, if net income is misleading, then any metric that uses net income in its calculation is also misleading. This includes return on equity, return on assets, earnings per share, yes, the debt to equity ratio, just to name a few. Now, first things first, let's establish my buying criteria. And turns out my buying criteria, it's super simple. I look at stocks like actual businesses because that's actually what they are. And when I buy a stock, I'm buying a piece of an actual business. And when buying a business, I treat it like any asset. I ask the question, how much money am I putting in to buy the business, and what is my return on investment in terms of cash flow available to owners? Now, this way of looking at investments fits really well with dividend investing and dividend stocks. This is because dividend stocks in general are stocks that have grown to a point where the company has decided that it's more worth it to pay its income out to shareholders instead of reinvesting it to grow the business in the form of capital appreciation. That's why cash flows of dividend companies in general are pretty good estimates of the value that a company is generating in the marketplace right now. And as we recall, I'm looking at the stock right now, it's at $7.95 as of October 25th when I'm recording this video. It's got a market capitalization of close to $250 million, a levered free cash flow of almost $46 million. And I mentioned this is enough reason for me to take a look at the stock, because if I take a discount rate of 10%, the stock should still be worth over $400 million, which means it's severely underpriced right now. So, alright, so I'm in the consolidated balance sheets of Medical Facilities Corporation, and the balance sheet is basically a financial statement that lists the value of each account that a company has on a certain day. So for example, the company currently has almost $39 million of cash in its bank account on June 30th, 2019. And so just looking at this, we can see that in both years, both 2019, 2018, for the 6 months ended, the company can cover its short-term current liabilities just fine. That's not a problem. Something interesting that you should take note of when you're analyzing this company is this right of use assets that didn't exist before, and this lease liability that didn't exist before. Now, they tell you to look at note 14.24, but I'm just going to tell you right here, the accounting standards changed, and beforehand, the company would recognize operating leases and the costs associated with operating leases as selling and administrative expense. But after the accounting rules changed, the accounting rules now require you to list the value of the operating lease of the assets as an asset, as well as the present value of the lease liability as a liability. And so instead of reporting selling and admin expense, instead of reporting the operating lease payments in that selling and admin expense, now the lease payment will go through cash flows, your cash flow statements when you're paying a liability, but it will also go through your income statement as a depreciation expense, okay, specifically the depreciating of the right of use assets. Okay, so that's just a key thing in the balance sheet to take note of. The actual business itself didn't actually change. Why? Because before this year, these operating leases were just still here. They just weren't recognized on the balance sheet. So don't just look at this increase in liabilities and just be like, all right, the company is more leveraged. It's not. It hasn't really changed. Okay, it's just the way of reporting is different. Now, another thing that's also worth noting is this deficit right here. The company has run a deficit for literally the last 15 years that it's been in operations. And you're probably wondering, how can a company actually do that? Well, this deficit actually isn't that bad of a news. What do I mean by that? Well, in order to calculate this deficit, we either have to have a bunch of net losses, right? Or the dividends that the company pays is consistently more than the net income that it makes. That's the only reason why retained earnings would decrease or this deficit would increase. So for this company, they've consistently paid more dividends than the net income that they're reporting. Now, you might be wondering, how is that even possible? Are they borrowing money to pay their dividends? Well, the answer is no, they're not. They're doing that mainly because the net income is not representative of how much cash flow the company actually is generating in their business. And I'll go over that in a bit, but the reason is mainly due to this exchangeable interest liability right here, and also the convertible debentures right here. And so what convertible debentures are a type of liability that when it matures gives the debt holders the option of converting the liability to shares of the company at a certain excise price, and if they choose to do so, that would obviously dilute the stake of existing shareholders and dilute shareholder value. But I've checked the information of these convertible debentures, and the excise price is at $16 to $17, which means they probably won't be excised in the near future because currently the share of the stock trades at $8 per share. So the company's probably just going to have to pay back the debt holders. Now, the other one, the exchangeable interest liability, has to do with how the business is currently set up. So currently the business owns majority stakes in over 8 different hospitals that are around the United States. But they also have physicians that also own the facilities as a non-controlling interest. And every quarter, those physicians have the option to trade in more of their ownership of their own shares for the shares of the corporation itself. Okay, so this exchangeable interest liability, its value also depends on the value of the shares of the corporation. And so if I go down to the income statement, which is right here, you can see that the net income of the business is affected by the change in value of the exchangeable interest liability, which is affected by the change in the share price. In other words, when the company's price of the shares change, the company has to run that as a net income or a net loss through the income statement. Same thing with the convertible debentures, all right, which really doesn't make sense for the company because these aren't actually things that fundamentally affects the company's ability to generate cash flow for the business and its shareholders. Now, one thing that I should note here is that there is a depreciation of right of use assets. Again, this used to be part of general and admin. This is why general and admin is such a lower number. It's because this used to have lease payments in there. One thing worth noting is that facility service revenue is a bit lower than before, but I wouldn't say it's material. This looks like regular business fluctuations. One other thing even more worth noting though is that this significant increase in salaries and benefits, I know that at least 1.1 million from here is due to a severance pay that was given to an exiting CFO. There's actually a new CFO that's actually been the CFO for this company for only 3 months. The previous CFO was the CFO for about 2 years. And so there's top management change. I don't know if I should be concerned about that. I probably should, but there just isn't enough information to really tell me what I should be concerned about. And I feel like if there was, it would probably be already priced into this security. 29.5 million in impairment of goodwill. I should definitely pay attention to why the company did that. And the company actually did that because of poor performance at one of its facilities, specifically the UMash facility. Right here, you notice that their revenue actually decreased by 33%. Okay, and that's the reason why this decided to take that impairment loss. It's because the intangible assets at this place isn't actually worth that much, they've determined. So all I'm trying to say is that this net income doesn't say that much. Okay, so what number should we actually look at? Well, let's look at cash flow. Okay, just looking at the cash flow from operating activities, 40 million, super happy. We noticed that compared to last year, this year the business isn't really looking at making any acquisitions or business combinations. Last year they did so, partly financed by the operating cash flow and also borrowings. All right, so based on this information, we know that this business is sustainable. Why? Because it's got positive operating cash flow, which is good. And it's got enough cash flow to cover its capital expenditures. It's got enough cash flow to cover its lease liabilities. All right, so we're back at looking at UMash right here, right? Remember, this is our cost for concern. Their revenues are a bit lower in a couple of the facilities, but they look pretty much like regular business fluctuations, except for this UMash thing right here. Okay, and they tell us that it's due to the case mix and the patient mix that the revenue is down. But we want to see if this is going to sustain into the future, because if it is, that might be a cause for concern. Okay, operating expense. I'm not going to look at this because it includes a lot of goodwill impairment and whatnot. That shouldn't really be a part of operations. Same thing with income and loss from operations. Okay. As we scroll down here, though, there is a really interesting number right here. And it's that even though in 2019 we're generating 100 million in sales in Q2, our salaries and benefits are much higher than in Q4 of 2017, okay, and even in Q2 and Q3 of 2018. So really, we want to be aware of this issue. It's not an issue just yet, but if it persists, it might indicate the company's having problem in actually managing their costs and keeping their gross profit margin high. Okay, we're going to continue to scroll down. So we see a really interesting number here, really interesting calculation. This is probably the most important calculation in the whole document. And this is the company's way of calculating how much cash is available for paying common share dividends. All right, so just looking at the 6 months ended in 2018, the company has more than enough money to cover its dividends. It's not the case for 2017, mainly due to, you guessed it, the decrease in revenue and the increase in expenses. That's really it, okay? The lease liabilities and all that, the impairment in goodwill, none of that actually affects anything. It's UMash that's mainly the problem. Okay, so we're going to see if this sustains into the future. But even if it doesn't, let's pretend the company does not get any better. It's going to continue its current operating cash flow for the 6 months ended in June 30th. Okay, so I'm thinking if in 6 months the company can make 40 million in operating cash flow and business is better the second half of the year, I'm willing to bet that the company will probably make a 90 to 95 million cash flow over the year of 2019. Now, I see a really interesting number here because I get to see company's payment and lease liabilities is going to probably be 11 million for 2019. Capital expenditures is probably going to be about 3 million for 2019. Okay, 11 million and 3 million, so that's probably going to be about 15 million. I'm rounding up here for 2019, including about, I guess, 30 million to the non-controlling interests of the company. Right, so we've got about 45 million of cash flow that will go out, that is probably required for the business to pay, minus a 95 million cash flow that we estimate for the company in 2019. And that actually leaves us with the company making an operating cash flow of 50 million. And obviously it still has to pay its interest and all of that. I'm going to overestimate and I'm going to say that that costs 10 million. So what? So that still leaves $40 million to the owners of the company. For a company that is selling for $250 million on the market. Okay, so if I take my calculator out and I divide 40, right, by 250, as my return on investment is about 16%, which I'm actually pretty happy with. In conclusion, the reason why I actually decided to buy this company is because I believe they're at a turning point where the company is actually underpriced for the cash flow that it generates for its shareholders. Remember, it doesn't have to pay out all of its cash flow in dividends. It doesn't have to do that. And if it doesn't do that, it's fine, because the value of a company is dependent on the cash flow that it generates for its shareholders, whether it pays it to the shareholders or not. And if the company really is sitting at a value of 250 million, at $40 million of cash flow per year in a negative estimation, because to be honest, this is not a good year for the company, and the company just holds it at this point, that's still a 16% return on investment. If the company declines another 50%, that's still a 8% return on investment. This is kind of why I've decided to purchase the stock. Really, the cash flow is nice from the dividend, but it really has nothing to do with the dividend itself. It has to do with the valuation of the company. Now, a cause for concern would be if the company continues to decline in value. In other words, if the revenue of these facilities continue to decline and the income continues to decline indefinitely, then that would be definitely a cause for concern. I would have to come back and reevaluate and see if I have a way to minimize my losses. But for now, I'm pretty happy holding this for the long term, trusting in the management that it will at least maintain its current level of cash flows, and I'm a happy camper. So that's my objective analysis of the stock. If you like this in-depth video, please give it a thumbs up, give it a like, subscribe to my channel, and pay attention because in the future I'm going to analyze more and more stock, and hopefully together we'll get a better understanding of what businesses actually try to hide in their annual reports and how to tell the truth from the lies using the financial statements of the companies and using the numbers that are right in front of your eyes. I would like to thank you for watching, and I'd like to see you next time. Bye-bye.